Good morning, welcome to SOXX Insights. Today is another market update just after the FOMC, during which the Fed cut 25 basis points. We're going to take a look at the details of the FOMC against the wider macro context before reviewing our progress in the S&P 500 as well as the chart technicals for bonds, oil, gold, Bitcoin, and Max 7 stocks. So let's begin. Before going into this FOMC, the Fed is primarily concerned by the rise in unemployment rate and a sudden drop in the non-farm payroll numbers in the past 3 to 4 months. So right now we are seeing an unemployment rate of 4.3% against a CPI of 2.9% year on year. The Fed's target is 2% inflation rate measured by the PCE, which is slightly different but is released later in the month. So we have the inflation data for CPI already, so we're going to use that here. So CPI 2.9% year on year is actually not that close to the Fed's 2% target. Now the unemployment rate at 4.3% is still pretty low against historical levels, but it's the trend that the Fed is worried about. Unemployment rate plateaued for most of this year between the 4 to 4.2% range, but recently it had a sudden breakout into the 4.3% level. And if you look at historical levels, when unemployment rate starts to rise, it tends to move really sharply. First from 2001 to 2003, the unemployment rate nearly doubled, and again from 2007 to 2009, unemployment rate doubled to 10%. So, and those are just within 1 or 2 years. So there is a heightened risk now that we could also see unemployment rate spiking sharply in the coming month. And the issue with the labor market is that after the COVID pandemic, we had a drop in immigration levels, which constrained the supply side of the labor market. That meant all the jobs that were created had excess demand versus a drop in labor supply. So the labor market was very tight. You could describe it as even more than maximum employment, because there were more employers looking for employees than the other way around. But coming into this year, end of last year to this year, what we're seeing is that the balance between the supply and demand is much more equal. And not in a good sense, because yes, the supply has dropped, but at the same time, the demand for labor has dropped, the job opening rate has dropped. So actually, it's more equal now, it's more balanced, but potentially at a lower level. And a decrease in the jobs creation and a sharp rise in the unemployment rate is a potential headwind for economic growth, as well as the potential pathway for a recession. And you think about the GDP, it is by and large a function of how many people are working and their productivity times how many hours they're working. So this could become a severe problem for the Fed. Therefore, they decided to act by cutting 25 basis points. What's a little bit strange is that in the quarterly summary of economic projections, the Fed actually projected better economic growth for 2026 and 2027 than the June projection. So they've actually revised up what they think GDP should be in the next couple of years. At the same time, they have revised down their expectation for the unemployment rate. So from 4.5% that was projected in June to 4.4%, and from 4.4% projected in June to 4.3% for 2027. And then you have inflation expectation being revised up as well. So you have back in June, the PCE was expected to be 2.4% in 2026, but this time around in September, the Fed projects a PCE of 2.6%, so 20 basis points higher. So what's strange is that against a better projected economic growth rate and a lower unemployment rate and higher inflation rate in terms of the expectation for 2026 and 2027, they're actually revising down the Fed funds rate. They're actually saying we should cut more, even though we think things will become better. And in the press conference, Powell was asked about this contradiction. He didn't really explain it very well. I think he explained it in a mechanical sense that everyone writes down their own projections for each of those items, and then we just summarize the consensus as the median and also the range, etc. And this is the outcome. So no one's colluding with anyone else. Everyone just writing their own expectation, and this sometimes you have misalignment in those set of outcomes. But what I think implicitly, it means that the Fed has a dovish bias now, regardless whether the pressure is coming from the White House or the fear of recession, or even maybe Powell worried about being labeled as the chairman who's acting too late all the time. Now there is an implicit pressure to cut rates and be more dovish than they had been. And if you look at what the market is pricing versus the dot plot actually followed what the market had priced in advance, 3 cuts in 2025, which implies 25 basis point cuts in each of the September, November, and the December meetings. So the next 2 meetings will also see cuts. For 2026, the FOMC projects only 1 cut, as well as another cut in 2027. Whereas the market thinks we can see maybe 3 more cuts from the end of 2025 by the year end of 2026. And actually from 2027 onwards, we could see rates plateau or even potentially hiking again because of the inflation resurgence potential. And this is where the market is landing right now for the FOMC decisions. So we track the market pricing for each of the meetings using the Fed funds futures. For now, the market expects by this time next year, we're going to see the Fed funds rates dropping to around 3% or even below. The Treasury yields has steepened slightly over the past week. So we're seeing the 30-year yield at 4.75%, whereas the 1-year, 2-year yield around 3.6% level. So there is a pretty much a normal curve now. We don't have an inversion, as much inversion anymore in the front end. I think for long-term investors, just from someone who has investment horizon of 10 plus years rather than trading monthly positions, the 10-year at 4% and 30-year 4.75% are still very attractive outright levels. And I have been very clear on that since the beginning of the year. If you think about the earnings yield of where the S&P trades, and given the implicit risk involved in trading equities, the 10-year yield presents a risk-free bargain here. Looking at the S&P 500, and of course SPY is the ETF, it's had an above average year so far up to this point. So we're comparing this against the past 10 years, and just bear in mind the past 10 years actually had quite elevated returns compared to the historical levels because of the cheap money flowing in from the QE as well as fiscal spending from COVID. So it's still doing pretty well at this point in time compared with the past 10-year historicals, especially considering we had a massive crash at the beginning of the year, which almost touched 20% by beginning of April. When we have more than recovered that and going on to be now, I think it's a top 5 against the past 10 years. And it's, well, I do think we could get a pullback, but I think we are going to see a double-digit year, even with the pullback this year. The question is, from here onwards, after the cuts, what could the SPY do? So I have looked at the past 4 rate cut cycles from the great financial crisis to the last year's mini cutting cycle, what we see is that on average, equities do perform pretty well in the 3-month horizon. The thing with 2007 and 2020 is that both were recession periods, and the great financial crisis, obviously a massive recession. Still, what we saw was that SPY continued to rally into November, so 3 months from the first cut, and then it lost about 40-50% in the next year. 2020, we had the emergency cuts in March, but everything was falling apart. Everything tanked until the Fed really stepped in, cut rates to zero, and started launching an avalanche of QE. And then the market did a V-shaped recovery in the following 2 months. I don't think 2007 or 2020 is that applicable to today. 2019 was a little bit more similar in the sense that we had a trade war, we had Trump as the president, we had tension between China and the US, and economic growth was weakening. So the Fed did a preemptive cut, but at the time, inflation was near 2%. Inflation wasn't the biggest problem the Fed was concerned with. It was economic growth. So compared to today's level of nearly 3% inflation, 2019 is not so similar either. So actually 2014, last year, was the most similar timing to today. And if we compare the two, so on the left, there's 2024, the 6 month leading up to the first cut in September, and the second chart on the right showing this year between February and September. We're going to compare some of the non-farm payroll levels, labor market levels, as well as the inflation levels to see what's different. In 2024, unemployment rate started rising from below 4% to 4.2%, and that scared the Fed a little bit. But if you look at the non-farm payroll levels, they were sub 100K, but still they're pretty solid by and large, even after revisions. Whereas if you look at 2025, we had non-farm payrolls around the 10K, 20K level, and even a negative month reported in July for the June data. And unemployment rate is now very sticky around 4.2% until the past month where we got 4.3%. And unemployment rate came from 4.1, 4.2% and now breaking out to 4.3%. So this area here does warrant a lot more concern than back in 2024. At the same time, inflation in 2024 actually looked more tamed because the headline CPI was at 2.6% versus 2.9% today. We have PCE at 2.3%, which is pretty close to the Fed target versus 2.6%, now moving away from the Fed's target. PPI was also at a fairly benign level in 2024, whereas now it's been rising into the high 2%. And the danger is that PPI could feed into CPI. There's a historically high correlation between the two measures. So all in all, 2024, the Fed actually had more room for cutting without worrying about inflation as much, coming from a very high base of 5.3%, whereas today we're at 4.3%. Inflation is still pretty sticky at a high level, but the Fed is a bit more worried about the labor market. So in 2024, the Fed probably didn't need to do 50 basis point cuts, but they can afford to do it. Whereas today, even if they needed to do 50 basis point cuts, which they don't, but they can only really afford the baby steps of 25 basis points, trying to contain inflation at the same time as rescuing the labor market. So in 2024, we saw that equities were already at an all-time high going to the Fed FOMC meeting, but the Fed cut 50 basis points anyway, and we saw largely higher returns for SPY in the following 3 months into December. Although there was a bit of volatility along the way, but the overall direction's up. So today we are in a very similar position where we are seeing all-time highs in equities as the Fed cuts rates again, and we could potentially see a blow-off top going into December. And I think everyone expects a pullback at some point, but because of the overall positioning, a lot of hedge funds flows on the shorting side, and a lot of large institutional investors being on the sidelines since the April rally, waiting for the pullback. Any dips could be chances for them to join the action or close their short positions, and therefore it could be quite shallow. And the current regime is still very much a buy the dip opportunity. So SPY, we are very much in an uptrend, holding pretty well. We're seeing new all-time highs almost every week since June, and the overall incline has been the same shape, staying pretty much above this trend line throughout, except for one day, and it recovered pretty quickly. What we're seeing is that SPY is trading at the 20% extension of this wave 1. And this is technically a stretched territory for this bull run. But given the market momentum and the Fed just cut, there is no real reason why we can't reach 690 next. As long as we're holding well above this trend line, as well as the 50-day, and in my opinion, the 50-day is much more important, with this volume profile acting as support around the 640. We could get pullbacks, but ultimately the direction is still upwards. QQQ's move is more advanced than SPY in terms of the relative levels. It's now trading at near the 2.38 extension of this wave 1, and we are already in the stretch territory for this wave 3. But I do think 608, 609 is a realistic target in the near term before we get some sort of retrace. Over here, there's not a lot of resistance or volume profile, so we're in a bit of a vacuum where prices can spike quite quickly and drop quite quickly too. The 30-year yield, I'm the first person to admit that my previously bias towards yields moving higher is now probably invalidated, especially after breaching this 200-day moving average. So now the risks, and if you just look at this being a head and shoulder pattern, we breached the neckline here. So we're probably seeing more downside from here. It's challenging the 200-day moving average, but not quite get above it yet. I don't think we have finished wave 3. I think wave 3 could get to below 4.5% on the downside. This sharp move down is a little bit shallow for wave 3. And once we get to wave 3, we can see a more substantial bounce. But I do think the near term is now looking more like the downside. With TLT, it's the reverse image. It broke out of the trend line this month, and we're potentially seeing not quite the wave 3 high. I think we should have one more high to go for the wave 3, but we're trending towards there. For oil, not a lot of price action have really happened. It's just been hovering around the 200-day and 50-day moving averages in the sideways fashion. So I'm pretty neutral here with a bearish bias. In my opinion, there's not much to do at those levels. Bitcoin's chart is actually not that easy to decipher right now. There is a potential that we completed wave 5 here just by looking at the charts, although I do think the fundamentals support further upside. And if we did top here, we could have the wave A here and a wave B corrective bounce here. And I just want to explain a little bit why I'm cautious on this bounce. if you look at the length of this first wave here versus that drawdown, we are now just topping at 1.236 extension of this bracket wave A. So typically wave C could end anywhere between 100 and 123% extension of this wave A. It's not 100% all the time, but this is a very common occurrence. So until we see a sustained break above 109K, ideally 120K, this could be still just the ABC corrective rally for this larger degree wave B, which means we can see one more low to go, pointing down to a larger pullback. For now, I'm leaning a little bit more neutral, so I just want to observe and let the price action tell me which way round it is. Ether, I think, is a bit more clear that we're in a much more constructive uptrend, even though we have consolidated for almost a month now. So I still expect the wave 3 to be somewhere in the 5,600 to 7,300 region as the base expectation, and this is largely a bull flag, just cooling off from this rapid ascension that was riding the wave of treasury companies for Ether. Solana, I also think we're in wave 3 of 3. So my expectation is that we could get to 300 in the coming month. Coinbase was pretty bullish yesterday with a large 7% rally just above the 50-day moving average. So that's pretty encouraging. I want to see it sustainably fill the gap, and then that should really diffuse this concern for the 5-week down and give us the hope for the final wave 5 in the high 500s to 600 region. But right now, I'm a little bit worried that we've had a wave 1, wave 2, and wave 3 retrace, and then an ABC correction for this wave 4 still. That could still be the case, which means there is the wave 5 to come. So I, as much as everyone else, want to see this potential count invalidated, then we can get back to our expectation for this just being a wave 4 correction, and then wave 5 higher. Robinhood, very bullish. I think we can approach the 130 level for this wave 5 in the coming weeks, definitely before the year end. It's a quite low hanging fruit at this moment. Gold, I think the uptrend is still very clear. Momentum has dropped slightly, and there is a lot of volume building here, but this looks to me like a bull flag to me, and I think we can get to 350 in this final wave 5. Looking at Apple, I'm pretty bullish on Apple and have been pretty bullish since August. I think it looks still very much on track for this wave 3 target of 264. Of course, we do have upward channel that is a little bit shallower than that. It doesn't look too steep, but the overall trend is still pretty much upwards. So I would say stay with Apple for the near term. Amazon, my read is still overall pretty bullish. We have a target of 250 for this wave 5. It has consolidated a little bit in the past week, but given that we made a new high in early September, which means we are probably have started this wave 5, I do think we should get there before the year end. Google is a stock that is defying gravity right now. So when everyone's bearish, it just takes a long time to break out, and finally up we go from 150 now to 250 in just a couple of months. So when Google is this stretched historically in terms of the RSI, in terms of the large 10% increase, 9% increase in a day, it usually mean reverts within the next 2 or 3 months. But obviously we're getting a very bullish action straight away here. I'm cautious in chasing here. I would say wait for a retrace, and I think at around 200, low 200 is still a pretty good opportunity in terms of valuation and everything for buying Google. Meta, my concern is that we have a wave B rally here. So wave is three-wave fashion. I think we can invalidate this if we get above around 800, but otherwise there's still a chance we can test 700 in this wave C of 4. Microsoft doesn't look too bullish. The model has been on and off, quite neutral for Microsoft. It does feel like it's getting a little bit stuck at the 50-day moving average, which is not good. And this could potentially be a wave B bounce. So there is still a big risk that we can see one more low in this wave C, and that could present a buying opportunity in the high 400 region. NVDA, again, this did look like a wave B corrective rally, and now we could have wave C one more low again into the 155, 160 region. We did get a pop yesterday upon the Intel investment news. AMD suffered as a result of that, but it's not constructive enough to say that we've finished the pullback entirely. So I will still wait and see how the chart resolves with a slightly bearish expectation for the short term. Tesla, the chart is stalling a little bit in the past 3 days. But if you look at here, we had a 7% rally in a day, and also the RSI is now entering the high 70s level, above 75. I looked back the historical instances. Since 2018, the 1 month forward return for every time Tesla entered the 75 or above RSI level, there were 21 occasions apart from this one, and only 4 occasions suffered negative returns in the forward 1 month period. So that's a pretty good hit rate with 80% chance of Tesla moving higher within the next month after entering the 75 RSI level. Overall, I do think we can stretch to 450 at 1.618 extension of this wave 1 before a pullback in wave 4. Palantir, pretty bullish price action yesterday, followed by a slightly consolidation pattern from the prior week. It does look like we're on track for this wave 5, and that could reach above 200, 210 even. And that will surprise a lot of valuation bears. Valuation bears being those who have been screaming Palantir is too expensive for some time now. Unfortunately, the stock doesn't trade against the traditional valuation framework, just like Tesla, and being right but losing money is as bad as being wrong. So there we go. SOXX semiconductor has been more bullish than I had expected, especially given the price action in NVIDIA and AMD is making new local highs with SPY and QQQ, and it could reach 280 in this short term. So we just have to see before preempting the wave 4 pullback. I don't regard this as a wave 4 pullback just because it's so shallow. So I think wave 3 is still intact. So that's it. Thank you for watching this week. I'll see you next week.